Hello, and welcome back to Private Markets 360, S&P Global's podcast dedicated to enlightening and educating our listeners about the world of private markets from vast vantage points. Your Private Markets 360 co-hosts both sit within market intelligence. I'll start off with introductions. I'm Jocelyn Lewis, head of private debt commercial strategy.
And I'm Jocelyn's co-host, Chris Sparenberg, head of private markets commercial strategy. I'm a super fan of our corner of the investment industry. We're thrilled to bring our listeners exciting guests every month for discussions about industry trends and other topics of interest here on the podcast.
We sure are, Chris. And if you're interested in regular private markets content, hit subscribe and tune in. Ready to introduce our guest, Chris?
Let's do it.
Welcome to Private Markets 360, your insider's guide to the world of private investments. Today, we're thrilled to introduce Joel Holsinger, a distinguished partner and portfolio manager at Ares Credit Group, where he co-heads the alternative credit division. With a wealth of experience in senior roles across credit, Joel has played pivotal roles in various investment committees and has been instrumental in shaping strategic initiatives in alternative credit, where he has been investing for over 27 years. And beyond his impressive professional achievements, Joel is deeply committed to charitable contributions, particularly in global health and education, serving on the board of Path Global Health. Today, join us as we delve in to his insights on alternative credit and his passion for making a difference in the world. Joel, welcome to Private Markets 360. Such a pleasure to have you join us. How are you?
Thank you for having me. Normally I'm used to getting the distinguished comment because of the silver hair. It's a little different when I'm on a podcast and getting called distinguished, but appreciate you putting me on.
Well, we're thrilled to have you here, Joel, and we'd love to begin with an overview of Ares and how you define private credit.
So Ares overall is a public asset alternative manager, $464 billion of AUM as of last quarter. And what we're really known for and kind of speaks by the size of our AUM is credit or private credit. Over 330 billion of our AUM is within credit. And I sit within the credit group in alternative credit, or as some others will call it, asset-based finance or asset-based credit. And that is over $40 billion of AUM and growing today. When we look at defining alternative credit, it really is that asset-based finance, asset-based credit. And what we mean by that at its simplest basis is everything we lend against, everything we invest across our portfolios of assets. So one, everything's a portfolio. Everything has contractual cash flows that are coming off of those. It's interesting for the wide variety of underlying asset class we invest in. Everything is getting paid on those contractual cash flows, either by a corporate or by an individual or consumer. And we really, at its simplest basis, we invest across those both in lending. We own them sometimes, portfolio of credit-related portfolios, and we play in the liquid side of the markets, which for us is the asset-backed securitization market.
And as we think about those pools of capital that you're mentioning, which are the ones that you currently think are offering the best relative value?
So there's three pools of capital we invest across in alternative credit. There's our insurance solutions bucket, which is really investing across investment grade and mainly for insurance-related LPs and some of our partners. And then there is the more opportunistic pool of capital on the other side of the spectrum. And then there's the middle or kind of more of a core type of a focus with regards to down the middle, which would be more comparable to direct lending from a return spectrum. So when you think of those three buckets going left to right, the insurance solutions is more IG. So you're thinking of 150 to 300 basis points above kind of corporate IG and spreads. Across what we do in the middle, it's generally kind of 450 to 650, 450 to 700 spreads. And obviously, opportunistically, our returns above that. So you're normally looking at stuff kind of 11 to 15% plus. Really, it's less of one area is more interesting from a relative value versus the other. In all markets, we drive that excess spread above corporates across what we do for insurance solutions. And there's no doubt the biggest part of the illiquid side we play on is right down the middle. The biggest part of the pyramid is obviously the base. And when you think about the ability to originate private transactions that aren't rated, that's a very large part of our market. And so there's always something to do. It's much more the relative value is what asset classes you're investing in and less necessarily the pool of capital. And opportunistic, I'd say it's more of a Navy SEALs approach or a tactical approach, where you are investing in things, but what you're really using is size, both across what we do in the illiquid side, the both pools of capital. Scale is really the relative value lens we're seeing the most today. Our ability to go find new originated transactions that have that scale is kind of the key to what we're doing across all asset classes, whether it be in resi, whether it be across capital relief, whether it be in fund finance.
Yeah, the scale of private credit is just remarkable. Thinking back, well, Joel, I'm sure you've seen it after investing for over 25 years, but now the size of the private credit market is just remarkable. And you also noted that alternative credit is the fastest growing segment at Ares. And that is quite remarkable given you have such a diverse investment portfolio. And that aligns with the broader trend in the private credit landscape, particularly with the rise of direct lending and that expansion into alternative credit. But can you share a little bit about the history of this evolution and the market dynamics that are fueling the demand for private alternative credit?
Yeah, it's interesting. I've been doing this, as you stated at the top, for 27 years, and I got my start with Citigroup coming out of college. And the types of investments that we make today are very similar to the types of investments I was making over 25 years ago. It's just that instead of them going on the bank's balance sheets, they're going directly into our funds and our pools of capital. What's really changed, that evolution has been similar in direct lending as it has been in asset-based finance, which has been the gaps that have been created by this market. If you think of direct lending, everybody knows that story. Everybody knows that it used to be held in banks. And if you go back to when I started my career, it was held in concentrated levels by banks. And then if you go to 2002, 2003, everybody was syndicating that and going a little more balance sheet light. And then clearly by the coming out of GFC with some of the Dodd-Frank and other reforms, the banks were just a originate and distribute model. They weren't holding those assets anymore on the direct lending side. And that led to the transformation that you've seen over the last, now you're going on almost 17 years of growth across private credit as it relates to direct lending. If you take a step back and you think of asset-based finance, and as I stated earlier, the liquid side of our world is really the asset-backed securitization market. The market's been around forever. First securitizations really started in the 1970s in resi. They got to more scale in the 1980s. By the 1990s, it was a very established institutional asset class. And what you saw was prior to the GFC, it was very concentrated and very scaled. But the owners of those assets were the banks, but a lot of it in the prop desk side of the banks, your Goldmans, your RBCs, your Deutsche Banks, your others. But then also it was held in your GE Capitals, your CITs, and your capital sources, where they were using liabilities such as commercial paper to kind of drive those assets. And we have a newsletter we publish, we call in the gaps. And we highlighted, after the regional bank crisis, we called it It's the Liability Stupid was the name of that newsletter. It really, what changed or evolved to your question was the liabilities. And what I mean by that is, clearly, banks were pushed out of some of these sectors by some of the regulations because banks do generally present some of the most systematic risk because of the amounts of leverage that they're using, and they're borrowing shorter term, they're lending longer term, as we saw obviously in the regional bank crisis. But frankly, we've seen this multiple times through cycles. The more interesting part of our market was really that commercial paper market. When the commercial paper market fell apart in the GFC in 2008, what ended up happening was Capital Source converted to a bank. GE slowly unwound over the next really 6 or 7 years, the GE Capital side of their business, as well as you saw CIT file bankruptcy and the remainder parts of it get sold into a bank. So what happened to the evolution was you had a very large concentrated pools of capital, very scaled players, and it became very fragmented from, say, 2009 all the way till early 2000, I'd say 14, 15 and onwards. It became fragmented in that a lot of people raised small niche funds, just litigation finance, just specialty assets, just consumer, aircraft leasing, a number of other asset classes. And all of those used to be concentrated in those 4 or 5 holders. Ares really, in 2011, we acquired Indicus Advisors, and that was the beginning of alternative credit at Ares. We were one of the earlier players in the market. now going on almost 14 years of background in the space. We became a consolidator across that space. If you fast forward, as much as there's large scaled capital on the insurance side of what we do across various peers, as well as what we do on insurance solutions, where we've really scaled is on the illiquid side, the directly originated, directly sourced type transactions. And that is really just going back in history repeating itself from the standpoint of large scale partners that can use sourcing and can use their scale in order to kind of drive transactions. What you would see though is the difference is how we hold that. We're not holding it on a bank balance sheet. You're holding it on matched liabilities. You're holding it on matched funds. The funds match the assets, and you're not sitting there with a whole bunch of imputed leverage. And the thing that's often missed when people talk about the growth of private credit isn't just that the assets are the exact same as we were doing if you go back 20 plus years ago, but the spreads widen when they leave the bank. You know, when you don't have that access to cheap capital that banks do from a liability standpoint, and fund finance is the greatest example of this, you don't just go from, say, a 250 spread or a 350 spread over to 50 basis points wider. You generally go 200 to 500 basis points wider. The same exact assets that was getting done gets done at a much wider spread because it is done with less leverage imputed. It is done with less systematic risk to the underlying. It is done with matched funding and matched fund structures. And so that's really the transformation of the evolution you've seen is you went from 5 or 6 very scaled players to now a fragmented market along the way and to now a reconsolidating of this market that we've seen. And we believe we're one of the largest leaders on that, especially when you talk about the illiquid portion of our market.
So you touched on some of those consolidation trends that we are observing. And you even took us back. I haven't thought of the likes of Capital Source or CIT for a while now. So that really kind of brings me back. But it's interesting how you framed the liability side and matching the assets with the liabilities and also picking up the spread really said around 250 or so basis points as the banks were kind of coming out of some of the space, and then private credit, because the private credit managers have a higher cost of capital, they need to make sure that they're covering their cost of capital. And then it also takes into account that illiquidity spread. So when we think about all that and how it related to direct lending, how is that also coming together as you think more so about alternative credit and expanding beyond direct lending?
As stated, I think what you've seen is that same evolution that really got started in direct lending in 2009, 2010. We're just delayed on that same growth because what you're seeing is with Basel Endgame, with different changes to regulatory capital framework that's occurred both across, it's not just the US, it's occurred first across Europe and now to the US, obviously across Canada and Australia and other markets. That has had a ripple effect of certain assets fit very well and banks lend to them relatively aggressively. Other assets don't. You know, they're outside of that bucket. And so what we've seen is that there's been a growth in both parts of the market. And I'm just going to divide it for this purpose to the rated IG part of the market and the unrated part of the market. When you talk about the transformational pieces that are occurring, things are occurring in both markets. One, we're seeing this reconsolidation that I spoke about. We're seeing the ability to kind of bring capital and scale. But let's first just talk about the rated part of the market. On the rated part of the market, it used to be in the asset-backed securitization market, you would go to an investment bank and you would hire them and you would go accumulate your assets in your warehouse facility and you'd decide to securitize the assets. And that would get syndicated out to the market, but no promises. Unlike the leveraged loan market or the fixed income market, whatever it priced at, it priced at. You'd fill out your book and you'd do it. And you really only had 2 choices, print it or pull the deal. And pulling the deal was almost admitting failure and that there was something wrong with your transaction. So generally you would print it. And you'd pay the fees to the banker. And then obviously you'd get whatever market spread was on the underlying liabilities on financing your pool of credit card receivables, your pool of unsecured consumer, your pool of auto loans, your pool of media assets, whatever it may be. if you fast forward to today, the thing that's changing with the scaling up of some of the insurance solutions that we can do, as well as a small subset of others can do, is that's not the only choice you have. The other choice you have is to come to one of us, you take down the entire deal, you know exactly what your pricing is going to be, and you don't pay all those fees, but you generally are paying higher spread. Really what's happening is you're getting paid for sourcing, you're getting paid for execution, very similar to what you see in the direct lending market. And then the fees are getting transferred in the excess spread. And so that's transformational for two reasons. One, it's another ability to finance your liabilities if you're an originator of asset. It's another way to partner across those things. It definitely gives certainty of closing, but it also changes the public side of the market because all of those deals are done on a private rated market. And it's the exact same rating, the exact same risk. Nothing's changed with regards to advance rates or other pieces. But what happens is if you're traditional insurance or a traditional buyer in that market, every time one of those private deals gets printed, you're actually potentially reducing the size of the public market. So you're actually from a supply demand standpoint. So when you look at the market today and you look at how tight asset spreads have gone and where corporate OAS is on fixed income as well as others, there's a little sense of, yeah, of course, it's supply demand. It's the one rule in economics that always works. And so that traditional part of the market is really only in the beginning stages of that transition. And what you're going to see is to access that origination, to access that excess spread, whether you're an insurance company or whether you're another party who plays in that or isn't a buyer of those assets, is going to change. And it's impossible to understate how important sourcing and scale is when it comes to accessing that market. And then on the other side, you have the unrated, the direct origination. This would be much more applicable to direct lending or credit opportunities if you're talking about corporates, which is that same dynamic of assets that don't fit necessarily directly into that market, or you want to do on an unrated basis, or you're buying a portfolio of assets. That ability to write very large checks that are flexible in the way that you structure them, whether it's buying the portfolio, lending against it, playing in a structured equity or other form, what you're seeing is a narrowing with regards to those who can bring that capital and scale. And I think that you're going to see both parts of these markets, both the rated side IG for the insurance and the non-rated, only continue to scale. Because the thing that's underestimated is the size of this market. If you think of corporates, general estimates are $5 to $7 trillion. If you think of our markets, there's estimates over 30 trillion. Now, half of that is residential mortgages, but still it goes to you and Chris touch our assets every day. You know, when you're streaming Netflix, that's creating contractual cash flows. When you're streaming Spotify, that's creating contractual cash flows. When you leave your house or your apartment, that residential mortgage is there. The auto you're driving has a lease or car payment on it. If you think of credit card usage, if you think of unsecured consumer when you're buying online, all of these things, even across digital infrastructure, are creating assets that sit within asset-based finance. So of course, that market's only going to continue to grow and continue to scale. And the way you finance, that's going to continue to grow. And that's why we've seen the growth we already have. And obviously, it's why you're seeing this broad segment continue to expand.
And that's just the known universe in an area where Ares has been so active and built so much depth of offerings and different strategies. Then there's everything in the alternative credit space where there's a chance to be a first mover and explore new opportunities. Can you tell us what's on the horizon in the alternative credit space?
Well, we just published a white paper you can see on our website on fund finance. And that's a great example of that, Chris. Fund finance is an area that's been around for 20 plus years. But when people think of fund finance, traditionally, it was just sublines. I'm aging myself a little bit, but I can remember when sublines were a lot of headlines and a lot of the newspapers wrote articles on sublines. You know, were they good for the market, bad for the market? Was it financial engineering? You see that same thing spoken about today as it relates to NAV lending on either single funds or on secondaries. And you see that sometimes written about GP structured or GP solutions. And I think that same growth, I mean, everyone has a subline now, you know, whether you're in private equity, whether you're in credit, whether you're in real estate, I think the market's accepted that's actually a very good instrument that helps both the LP and the GP kind of manage capital and timing. I think that all things within constraints, obviously, if you went too long where the subline sat out forever, you did too much abuse of it, it can create to an issue. But 99% of the time, it's actually bringing a solution to the table. I think that same thing can be said in fund finance if you look at NAV lending on single funds. And it's not just private equity. It can be across real estate funds. It can be across infrastructure funds. It already is a more mature market in secondaries. You can actually securitize or get ratings on secondary portfolios of NAV lending, as well as we're seeing a growth in GP solutions, which is really either lending at the GP level against their co-invest, or it's doing something on a structured basis with the GP, including management fees, promote, and other things, which is aligning the skin in the game that the manager may have. It's them putting more investment into their underlying funds and kind of believing in what they're doing and doing that in a structured way. So I think those are areas that are still earlier stage on their growth and adoption. Some people barely know that it exists and are starting to become users. But it's all about communication with the LPs. It's all about the conversations with their LPAC and making sure that the proper disclosures are being made. I look at it simpler, which is the asset, our loan, is a great asset. It's normally on a single fund will be 10 to 20% loan to net asset value against a diversified portfolio. If you look at a secondaries basis, it might be against hundreds of underlying assets, hundreds of underlying companies, and it will be 30 to 40% loan to net asset value. But that's a great example of an area that's growing. Another area that's growing is capital relief in its broader sense. A lot of people have talked about SRTs or significant risk transfers, or synthetic, depending on how you want to define it. And if you look at those, that was something that's pretty mature market in Europe. It's been around since the GFC. You see some very active issuers. You even have shelves that are done in the asset-backed securitization market for that market, but really wasn't allowed in the US until about a year ago or a year and a half ago now. And so you're starting to see a growth across asset classes, both on the corporate, on autos and sublines and other asset classes. And some of those are done broadly against large portfolios of corporate IG and others. Some of them are done very bespoke, but bilateral type transactions where you're solving something the bank is trying to do. All of these are a reaction to Basel Endgame I mentioned earlier. All of these are a reaction to optimizing the capital for the banks and to make the asset more bank friendly. Because there's some areas where banks do them. It's almost the hot dogs or pizza at Costco. You're not really making money on it, but it gets a lot of customers in the door. I would say sublines fit into that category for a lot of banks. They don't make a lot of money on it, but there's a lot of relationship building that comes out of that and potential IPOs and secondaries and other M&A activity. So you're going to continue to see that theme. Those are areas that are only going to continue to grow. And all of that is kind of a tailwind to the space.
As we observe the evolving landscape of private markets, how are traditional banks adapting to this rise of non-bank financial institutions, particularly thinking about partnerships? And what role does private credit play in this dynamic? And how are these collaborations reshaping access to capital for businesses? Maybe talk a little bit about what implications these trends have on the future of banking and lending.
Yeah, it's interesting because we get asked all the time, do we partner or do we compete with banks? And the answer is yes. Clearly, we compete in certain portions of what we do, but the reality is we don't directly compete because the banks are 10 to 1 or more leveraged with a very low cost of capital provided by governments and others and their implicit support. And so it's not like we're directly competing with banks. It's much more of, does it fit into a bank box or not? And if it does, then they can obviously do things at a lower cost of capital than we have across most of the things we're doing. But there's a lot that doesn't. If you think about it, it's almost, I like to say, buckets and baskets are the pathway to beta. Your ability to play outside of the box in the gaps, outside of those buckets is where you actually really drive alpha. That's really where you're able to provide kind of excess returns for your investors. And when you think about, as much as we're competing because we're originating and talking to the same partner, same groups and others, we're really mainly partnering. Banks obviously lend against some of the funds across direct lending and others. They obviously sometimes are they're playing in a senior portion. We're playing in another portion of the capital stack. Clearly, the things I just described on capital relief or SRTs, we're partnering with banks. We're bringing a solution and scale to them that really helps them with their business. And so most of the time we are partnering. And I think that there's been some people that have spoken to that and said, oh, we compete with banks. I look at it as everything we do, we want to be balanced. Similar to insurance, we want to continue to be a partner to insurance, and we want to provide returns to them as well as find ways to partner with them on transactions and be investors and also work with them on deals. We want to partner with banks in that same kind of vein because the world is a big place. In our world, sometimes people will talk about captive originations or other things. And we look at it as, would you rather have a handful of people that you can go look at assets with, or would you rather have the ability to partner across a wide spectrum? Would you rather have the ability to partner with 5,000 plus originators of assets? That same thing is true with banks and insurance, which is the relationship is very symbiotic. It's different pools of capital with different return spectrums. And it's really those who can bring capital and scale are those that are going to partner. And I think it's the one thing that's interesting in our world is consolidation will continue because the advantages in credit of scale, both on infrastructure, on your ability to source liabilities, on your ability to solve people's problems in large scale, that's not going away. Private equity and venture, you do a couple deals a year. In what we do in credit, there's nothing that is the bigger competitive advantage than scale. Because that ability to be able to source and have more feet on the street that are out there originating assets across US and Europe and globally for all of areas, if you go broader than alt credit, that ability to bring liabilities to the table, that ability to have the right asset management infrastructure to go through kind of the harder times and through cycles, you're only going to see that consolidation occur. That is the biggest advantage we bring to the table. But that only works if you're the preferred counterparty. That only works if it's something where you are sitting there partnering with people and not sitting there treating a transaction as the last transaction you're ever going to do. You want repeat customers. You want that ability to continue to partner with them.
You can think of it also as building a partnership, building relationships, over time. You invest the time in, and then, generally it pays off. So completely understand there. And one of the aspects that you mentioned in terms of partnering with the banks was that Ares executed 2 large, or maybe the largest, SRTs for capital relief trades. And could you just break that down a little bit for our listeners? Why is that so significant?
Yeah, I can't speak to specific transactions, but it's been an active space for us. And it's a space, as I mentioned earlier, that is picking up because of the change in the regulatory and the ability to do those in the US. But that is really driven by banks optimizing their regulatory capital. It's driven by Basel Endgame. If you think of the changes that have occurred, there are certain asset classes that are still very appealing banks, and they'll continue to get done by banks. There are the others that are harder. And that ability to kind of structure those in a way to reduce the risk that they have. Because, look, at the end of the day, if you go back to the, 10,000 years of written history, basically the last several years, the one money multiplier that existed for a government was banks. That leverage was imputed. So, of course, there was an implicit guarantee that occurred with that. But if you look to the 1970s, as I mentioned earlier with securitization, and you look at insurance and you fast forward to today, there's not a pillar, there's 5 pillars. There's banks, there's private credit, there's insurance, there's securitization market. And then I would argue sovereign wealth and pensions act almost separately than apart from all of that. We all partner, but we all compete. And across that, if you look at the liabilities of those, it's matched funding on everything. Our funds match our assets. Any liabilities that are issued match that. If you look at insurance, you're matching to the liabilities of the insurance on annuities and others. If you look at pensions, you're matching, and sovereign wealth, you're matching to the underlying portion. The one area that's not matched is banks. So of course, most of your systematic risk is generally more on the bank side. And it goes to, again, the whole borrowing short and lending long. So given regulators do want banks to continue to be boring, the best way you can partner with them is to make them more boring, is to be able to de-risk portions of what they're doing on great assets to get better regulatory capital relief and help them with regards to driving those initiatives.
And Joel, shifting to a topic we both value, and that's charity. Could you share your insights on the global health and education charities you're involved in? Additionally, I think it'd be great to hear more about what Ares does to structure its donations to effectively support these causes.
Yeah, I come from humble beginnings. I'm a poor preacher's kid. Went to high school in Boise, Idaho, born in Eugene, Oregon, and I didn't know any of this world existed at all. I was totally oblivious to finance. I find that if you were born within 50 miles of New York, you're very aware of finance and that career path. And if you're born away from that market, most of the people on our team, you kind of stumble into it in some form or fashion. And I definitely stumbled into it. And I've been very lucky, and I think we're all lucky who play in this world. It's easy to look at relative value and that person that is in your firm where you say, hey, look, I should be at that level of promotion and I should be at that level of compensation. We often don't look at the 99% of the world that finance is generally doing better than a lot of the rest of the world. And so we are all blessed. And so I've set it up 15 years ago with my wife. Her dad originally moved to the United States from Peru. And so she also kind of came from humble beginnings. And when you look at it, we set it up for most of it to go to charity. And about 7 years ago, I joined the board of Path Global Health, which you mentioned earlier. And I'd already gotten involved with different charities, including UNICEF and Project Cure and Doctor Without Borders and Khan Academy and other things. But a trip I did to India really changed my life. I was having this concept of what else could we do? Could we do something bigger? And I went to India and we were working on a tuberculosis and HIV program in Dharavi, which is the largest slum in the world in Mumbai. And kind of came back with this concept and idea of what if we could do more? What if we could tie what I love to do, which is investing, in with a charity tie-in? So our flagship funds in alternative credit, what we set up was at least 10% on some and 5% on others. So 5 to 10% broadly of our promote goes towards health and education charities. And so we directly tied the mechanism of our funds and how we perform to what we can do for good. So we do good by being good. And that's really changed the culture, and the way we think about investing has changed broadly. Some of the mechanisms, and it's inspired and set up the Ares Foundation, which we now have broadly, which is granted over $50 million, separate and apart from what we've done with our flagship set of funds. It's become part of our DNA. I just got back from India 2 weeks ago. We've done that trip a couple times now with our team. We've started to make our first grants and donations out of that charitable tie-in, and it will only continue to grow from here. We've accrued, the last reported number, I think, is a little over $25 million we've accrued already in that charitable tie-in from our flagship funds. And that will only continue to grow, assuming we continue to perform with regards to those funds. And it's been game-changing for me. It's been amazing. It's been something that's really changed the way I look at the world. It's the reason I'll never retire. I get to do my two favorite things. And the impact you can have, if you look at, health and education, especially global health, the cost to save a life is around $3,500. And I think that every one of us, if we were looking at our neighbor or even somebody we barely knew, and we said we could save that person's life for that dollar amount, we would do it tomorrow. But we often don't see that. So being able to make those investments, being able to make those changes, being able to have that impact, I think that Wall Street is generally very generous, but we're not known for it. It's normally done on a personal basis. The ability to tie that in where every investment we're making across those funds has a potential to drive those charitable tie-ins, that's pretty impactful. Whether you're a senior person across the team or whether you just joined, you're having that impact, and it's part of what you're doing every day. And so we're hoping we can inspire others to do it. We're talking to some of our peers about that. And that's something that we really hope others will pick up and will copy and kind of drive, because those dollars and that impact is very real. And it's something that I look at it as, when you're later in life, those are the things you remember. That ability to kind of impact the world, that ability to teach, that ability to mentor, that ability to give your time, that ability to give your dollars. Those are the decisions that really matter. And I think that having that ability to do that on this platform, I have the greatest job in the world.
That's excellent. It's truly fascinating to hear all the commitment to improving global health and education. Is there anything that you have set a goal in order to achieve a certain level of, I don't know, saving X amount of lives or something like that? How are you able to quantify this impact in any way?
I can't project the numbers because it's considered to be marketing or projections or others for those purposes. And there's a lot of rules that go along with that with regards to fundraising and others. I definitely have my own internal goals, and so I won't say it on this call, but I look at it as if we do our job as investors, the impact and change we can have can definitely impact not even hundreds or thousands of lives, but literally tens of thousands and maybe more lives. And what I'm hoping is that it goes broader than that, in that other firms, other groups, other funds will be inspired by that and make that same impact. Because I've never had more clarity in my life than when we've made these changes. And it's really driven the culture. You know, you talked earlier about we're the fastest organic growing group at Ares. I spoke in Europe last week at a cocktail event we were doing. And I spoke about the hopes, the dreams, and the karma, because the person who had spoken earlier representing one of those charities had talked about the hopes and the dreams. I said, hope is where global health and global education can go, because it's not a story of desperation. It's a story of change. It's a story of impact. It's a story of bending the curve, because great things are happening across the entire globe. On education and health, it's changing so quickly, improving. What we can do, though, is make it happen quicker. The dream was to have that impact in what we do on a day-to-day basis. I have no real skills in life. I can do numbers in my head and I know how to invest. But in the middle of the GFC, I had this nightmare of I might be a farmer soon. This is what we know how to do, and it drives this impact. So that dream was tying those two things together. The reason we've been the fastest growing in my mind and why we've had some success is the karma. And the karma comes from, if you do good things in the universe, good things come back to you. And I think that's really kind of come through with that. And that is true change. And it's been inspiring. I always say the second best idea I ever had in my life was the charitable tie-in. The first was very clearly asking my wife out for a date and buying her a drink 27 years ago, because she may listen to this podcast. But in many ways, she inspired me to be a better person. And we're hoping through what we're doing on a charitable side that we can inspire others to be a better person and make that same impact in their communities and charities and other things.
Well, it seems like you have those priorities aligned very well, and it really is inspirational to hear everything that you're doing for these great causes. So thank you so much for sharing.
Thank you for having us on. It's great to talk about this. And if anyone has any questions, love to reach out on LinkedIn or through other resources. We appreciate the profiling, and we thank you for taking the time today.
Thank you again to our wonderful guest for a great chat today. We really appreciate everyone listening in. If you're looking for more private markets content, hit subscribe to catch future episodes and listen to our earlier episodes wherever you listen to podcasts. Cheers, everyone.
Thank you so much. You can also subscribe to our monthly Private Markets 360 newsletter. The link is in each episode bio, or connect with us on LinkedIn. Have a great day.